Good morning, ladies and gentlemen. Thank you for joining my session, Finance for Managers. This is a level 7 course, ATHE level 7. And my name is ATHE L7. Today is Saturday, and we're going to talk about understanding the importance of financial data in formulating and delivering business strategies. This is to do with your learning outcome number 1. Okay. So let's start. First of all, we need to distinguish between some command verbs like qualitative verbs like evaluating and assessing. So hopefully you know the difference between them, but let's go through them. Evaluate means just making a qualitative judgment, taking different factors into account and making those decisions based on your experience, knowledge, evidence. And assessing is something to do with your offering a reasonable or reasoned judgment of the quality of service or skills or standards based on some relevant facts. Okay, so you need to be able to make some decisions or making sure that you know the distinctions between the evaluating and assessing when you do your work. Okay, what we're going to cover in this session is we need to look at different contents, like we'll be talking about financial data, information, and delivering business strategies. We need to know what the sources of financial information are, internal and external sources of finance, the difference between management accounting and financial accounting, or management information and financial information. Now, financial information is to do with your cash flows and profitability and cost projection, and management accounting is to do with your internal information regarding costs, for example, regarding the project analysis, making decisions according to your internal requirements. And we'll be looking at the business risks, okay, such as strategic, marketing, compliance, and so on. So the contents are very clear what we're going to cover. Good morning, sir.
Hello, yes, thank you. I've been listening for a couple of minutes now, so you can go on. Thank you.
Thank you very much for joining. Okay, so the first learning outcome, which is 1.1, okay, which is to do with your sources of financial data, which can be used to inform business strategy, i.e. we need to know what sources of financial data are there. Okay, so you need to distinguish between financial data and management data, or financial accounting and management accounting. Now, the management accounting is purely for internal management, making decisions internally, i.e. information regarding, for example, management decisions or investing, or which project to invest in and which is bad for investing, and so on. So the management information or the management accounting is purely for internal use. It's to make internal decisions for managers, financial decision making, whereas the financial accounting is purely for external use, i.e. informing other sources or stakeholders, for example, or complying to law, complying to lenders' requirements, complying to government regulations. So the financial accounting and management accounting are both different, and they both used for different purposes. Because one's used, management accounting is used for planning, and the financial data or financial accounting is used to record the financial performance of a business. Okay, and you can compare the financial comparison from last year to this year. Okay, so that's purely for comparison purposes and performance purposes. And There's no legal requirement to do management accounting. It's purely for internal management decision-making. It's purely for internal use. Financial accounting, of course, there is a legal requirement for companies, for limited companies. They definitely have to have financial accounts, audited accounts, and they got to be registered, and they got to be filed with the registrar of companies. And people who want to invest in these companies, people who want to get some information of these companies, they can get their accounts from the company's account by paying some kind of a subscription or some kind of a fees to get their accounts. Maybe it's not applicable to private limited companies, but definitely to public limited companies like banks, for example, or international companies, you know, like ICI, for example, or Boots, for example, or other public limited that are listed on the stock exchange. Okay. So that's the difference. And nature of information, or the format of information in management accounting is mainly management decision making, and the financial accounting is they've got to have a particular layout, particular company got to be able to form a particular style of giving information on their financial records. They have to have a proper layout on profit loss account and financial statements. They've got to comply with the, in a sense that it should give a proper and fair view of the information. They should have they should follow the company law. Whereas the formatting of the management information, there is no requirement as such. Okay. Time period for management accounting is based on historical and forward-looking, whereas in the financial accounting, it's mainly historical data, i.e. the past data. And the nature of information for management accounting is decision-making, financial and non-financial both, whereas the financial accounting is just based on the financial decision-making only, i.e. finances. Okay, so that's the kind of thing that the differences between management accounting and financial accounting. Okay, now coming on to what is a strategy, for example, here, understand the performance or financial data in delivering business strategy. Now, strategy means different things to different people. One word, strategy, to Chandler, he says that strategy is delivering the long-term goals and allocating resources. So to him, strategy is delivering long-term goals and allocating specific resources and choosing activities and making the best use of those resources. Whereas Mintzberg says it's a force between an organization and its environment, and making decisions according to these environments and how best to deal with these things. Okay, so different people will give you different definition of strategy. There's no one way. If you look at Prahald, he says a strategy is something kind of allocating resources to the best, how best we can allocate resources and the use of those resources. And similarly, Porter says a strategy is choosing a different set of activities to deliver a unique mix of value. So they're all different. There's no specific, there's no standard definition of what is strategy. Strategy is just a simple way to do things, the best way of allocating resources to an organization's need. And it depends what they mean by allocating best resources. So it's just a way of allocating things that they need with the best use of resources in their time. Okay, coming on to the next thing is data, the differences between data, information, knowledge, and action. Now, data means different things to different people. Data, information, knowledge, and action are all different things. May I ask, is it Alexander? Hello? Alexander, can you hear me? Okay. Right. Okay. You can't hear me. Okay, data, information, knowledge, and action is different things to different people. Now, data, for example, data is, when we look at data, it means data is raw materials for, or information, such as numbers to make.
I'm sorry, I had some connection problems.
All right, okay. I was just asking whether you know the difference between data, information, and knowledge. What do you think the data is? And I was just because I lost you, so I thought I'd just
Yeah. It was. I'm sorry. It was just on time when you were asking.
Yes. So data, I was saying, data is some kind of information. In other words, some kind of raw materials that we can use to determine information.
Right.
You know, so data is just what's it called, raw materials, right? To make decisions. So something like
Okay,
cost.
so the knowledge is when the data is already analyzed.
The data is not analyzed. Data is just a raw material, just unprepared materials, raw materials to prepare information.
Okay.
Yes. And data, when it's processed, it becomes information. So data, when you classify information, or when you put it in a proper way, in a proper group of data, in a proper table, for example, it becomes sensible. It becomes information. Yeah. So people can use that information.
Okay.
Right? So the data is just raw materials. For example, 55 people said this. Yeah. Or 100 people said this, or what did they say? And whatever they said, we put them in statements, for example. This is known as the raw data. When we put them into a classification, when we put them into, say, note from 1 to 10 people said this, and 10 to 20 people said this, and 20 to 30 people said this.
Right.
So classified data, it becomes information, much more sensible, and we can make use of it. So it's a group of data. It's a processed data. It becomes a processed data, and it becomes information. Okay. So this is the distinction. And the knowledge is something we get from experience. We get from our own awareness, becoming of.
I see. Okay.
So these words are used interchangeably, but they mean different things to different at different times. So it's very important to distinguish these words. Financial data, financial information, financial knowledge. So if you look at this slide here, financial data. So first of all, you get a data, which is raw data, which is unfinished goods, which is some kind of, numbers, for example, costs or whatever. Yeah.
Right.
So
right.
Data, then we process it, we put it into a kind of a logical order, and it becomes information. And this information is used to gather knowledge. And when we do our action, when we do our thing, that becomes a more sensible thing to do. So it's a flow of information that you get from one step to the right step.
Okay.
So we get information, we get data, we get all sorts of data from different sources. We get it from internal sources, and we can get it from external sources, right? Internal, when we're talking about internal accounting systems, we get it from different sources, different systems. For example, we'll get it from the data comes from managers, the data comes from suppliers, the data comes from customers, the data comes from banks, for example, the data comes from our inquirers, for example. Yeah, so there's a lot of information, or a lot of data comes from internal sources, and we have to process that information, and this becomes information afterwards, right?
Yes.
There's internal sources. We get internal sources from books, internal books. It could be, internal books from transactions, for example, when
Yeah.
sell goods. So the transaction this information is internal. And this transaction internal gets from primary sources, i.e. books of Parliamentary, books of what you call the day books, for example. Okay.
Yeah, accounting, right.
Accounting, yes, okay, or bookkeeping and accounts. So we get all sorts of data from raw materials, like data is a raw material. We get it from say invoices, and then we process those information, and that becomes information. Okay, so do you get my point? Okay.
Yeah, because you mean that there's an actual data flow from data transferring to knowledge, and at every step there's a process to comprehend it and to extract valuable information, valuable thoughts, and get the knowledge from the data from the raw one. Yeah, I get it.
Okay, so whatever data you get, you process it, and if you process the data as rubbish, it becomes rubbish information.
Right.
Then you your decisions on the rubbish materials, and if you get the data and process it the right way, you get a good information, and you use that good information to make good decisions later.
Right.
Okay? So whatever it says, garbage in, garbage out, i.e. whatever information you process from your raw data, you use that accordingly. So whatever do you understand? If you process rubbish data, it will become rubbish decisions. And
yes.
If you process good data, and it becomes good information, and you make good decision, it becomes good decision making. So very important to how you process the data. Okay. So so garbage in, garbage out, GIGO is the principle. Whatever you put in, you'll get that. Whatever information you want to get, it depends what data you input. Okay. And we get these information. The accounting systems is based on purely data. Okay. And purely data should be very good. The data is, if it's a rubbish data, then you'll make bad decision.
Yeah, garbage decision. Right.
These data got from the primary financial account is based on these transactions, invoices. For example, cash transaction, credit transactions, banking transactions, right? Or these are all primary source documents, and these are known prime book entry. And then we put those information into the financial data, which is known as the accounts. So whatever it's very important that we put the right information into the right books at the right time to get the right information and to meet our statutory requirements and everything else. Okay. Why do we keep these? Why do we keep, or why do the companies keep record? There are many reasons. I'm sure you are aware why we need to keep information. Is for internal purposes, for external purposes, for internal control, for checking to prevent fraud, for it's a legal requirement, and it's meeting customer inquiries, and maybe you need to know where your information going. Yeah. And if you need to make decisions, all this we need the information. We need to make sure that it requires to the we adhere to the public requirements or statutory requirements. We want to make sure that we make good decisions. We make timely decisions. So there are many reasons why we need all this information, all this data. So there's no one reason why we make this data, why we need this kind of data. So there is umpteen reason, as we need to know how much income we get. We need to know how much investment we need to make. We need to know how much expenses we have, how we control our expenses, how we are going to take our decisions, what type of products we need to produce, what type of transaction we need to cut out, and so on and so forth. There is millions and millions of reasons. So as we explained earlier on, early on about the information we get it from the primary source documents. So if you are looking at the you know, if you are looking at transaction, how many transaction cash sales we made, we'll have to look at our cash receipts books. Okay, we need to know, we need to look at our primary source document like till rolls, for example, or receipts.
Right.
Okay, and this goes into the receipts books, which is known as the book of Parliamentary. If we want to know how many credit sales we made, so the transaction is a credit sale, and that will go into the sales invoices. We need to create some sales invoices. And once we create sales invoices, they need to be recorded in sales day book. So, so the accountant gets their information from sales day book, i.e. how many credit sales we made, okay? And so on. So okay, it carries on, okay? How many sales returns? So when we sold goods, some default goods have to be returned to us. And so we made to have a sales returns book, okay? We need
right.
to...
So give me just a second to get this right. So like, for example, if I work in a company and I need to like withdraw raw data from one of the departments, right, where my colleagues work, and they just give me like already processed data. So they just give me a number, and they do not give me the access to the books, to the prime entries, to the primary documents. So it means that eventually when I do my research and I do my calculations, I will probably end up producing garbage knowledge because I wasn't because I hadn't been able to get the primary source documents in the first place.
Yes, so whatever they give you, you rely on that information.
Yeah, I mean, well, because they do, I don't know, like many reasons, many different reasons.
Correct,
Because they, so they need to, so there's always a reason, and the GIGO model is the reason to gain access to the primary documents, always.
Yes, and that's the basic job of accountant or bookkeeper. Whatever information they process, they'll give it to you.
Right.
And you rely. If you want to verify it, okay, yeah, then you need to go to the source document. Maybe there's a mistake. And if you find those mistakes, you have to correct the source document. And there's a source document, maybe somebody has entered this information wrongly in the first instance. So there's all this process have to go through the source document in the first instance.
Right, right.
And this is a very cumbersome thing to do, because imagine that all the financial accounts have been prepared, but they don't balance these accounts. And then where do you go? You have to go to the source.
Yeah, where is the error?
So it's a long cumbersome, and this is why the accountants have to spend lots of time finding these errors and going back to the source document and so on. Okay. So this is the whole process goes back. So if the information was wrong, that's the fault at the source. So the accountant has got to do two things. There are bookkeeping, as it says earlier, sources. So all these documents that we get, first of all, they are entered into the bookkeeping account, source recording. They have to be recorded properly. They've got to be recorded correctly, and they've got to be recorded update information correctly. And then they have to be processed. All this information, raw data, has to be processed, what's known as the financial statements, or summarizing these transactions. And then from those financial statements, you produce position of the company. Is it performance of the company? Decision making comes from that. Okay. So there's two elements: bookkeeping, and then there's accounting later on. And the accounting is to do with your financial decision making and the performance of the company, and those accounts got to be prepared according to legal requirements if you are a bigger organization, public limited company, and those accounts got to be filed with the public body, which is registrar of companies, and the public can get hold of those documents when they need to view accounts. If they are investing, for example, or if they want to buy a company, or if they want to sell a company, they, so this is why we use. But the management accounting, they don't bother about internal, because that's for internal running, mainly the financial bit. This is where other organizations, other people are interested in the company. How is the company doing? Where is it investing? Whether it's worthwhile buying this company. This is why you get, when we have takeovers or bids or mergers, they need to see the accounts. Yeah, they need to look at the accounts. Whether the company is a good company to buy or not good a company to buy. Okay, so for example, if you want to buy a Morrison, for example, you know, or if you want to look at the Morrison's financial accounts, you can go and look up their accounts anytime you want to. Okay, so this is, if you look at this slide, there is some information as to getting, you know, this information on profit loss account.
Okay, right.
So they have this website, you can log in and view them. Okay.
Yes, right.
So this is so what we've covered is 1.1, basically the difference between information, knowledge, where this information comes from, how does it become information through raw data and so on. So 1.1 basically was to do with your understanding of sources of data and how they can be used for financial decision making and so on. Okay. Right. Coming on to your 1.2, which is to look at the need for data and information in relation to business strategy. Why do we need this type? Why do we need this data? Okay, we need data for many different purposes. We need, companies need data to be more competitive, to see one organization competing against the other. So they have to, of course, they've got to make decisions. They've got to make sure that they are competitive against their competitors, you know. So they've got to have best possible ways to invest, for example, or best possible services to offer. So they've got to be, you know, buying and making decisions as to be competitive, right? So this is one reason. So they've got to compete against their competitors. So if they are good in financial data, if they buy goods very cheaply and they can make a good profit, they can become competitive. Or if they buy goods competitive, cheaper price, and they invest in good decision making, they can be competitive. Or they want to make the best use of resources, the best use of their products, the best quality of products they want to be offering to their customers. Of course, they are going to be competitive because their costs may be lower, or they are very efficient in costs. So there are many different ways of competing. So they've got to be more competitive. Okay, so that's the first reason. The second one is they've got to say satisfy their customers because they want to offer the best possible services to competitors, to give them more good experience, to make sure that they you know, are loyal customers. They come back to the organization to buy goods and services. Another reason could be that the company or that the business is offering good solutions, good local goods to the local people according to their requirements, according to their needs, according to their requirements. You know, they are offering the goods that the people want, not the whatever the company wants to sell, but whatever the local people want. So if you maybe different people want different products, for example, Tesco's has many units in all over England, but they in some locations there are lots of Asians, there are Africans, there are multi-ethnic people. So therefore, the Tesco now has differentiated these customers and provide local goods, local.
So. Depending on the local market.
Yes, what local needs, what local people want. So if I go to different Tesco units, Tesco supermarkets, I'll find these different products requiring different, serving different communities. So you can see that, and not used to be the case, but because they want to be competitive, because people are more diverse nowadays. They, live in different places. So these units are offering different products to their people's requirements. Okay, local solutions.
Yeah.
Okay. Do you get this in Russia as well? Are you from Russia? I'm guessing.
Yeah. Well,
okay.
it's actually quite similar, because we have that chain of Tesco stores. So it's called X5 group. So
Okay.
there are a lot of different names, different brands under the company, but they do still require the knowledge of the local suppliers and and local needs, because for example in the south they produce more more areas inside the stores for the fruits and vegetables, because local suppliers can provide more fruits and vegetables over there. And so in the north, where about 60%, 70% of Russia, I mean, area-wise, is located in the severe climate conditions in the north. So there are less fruits and vegetables over there, but there are more, supplies for making fire, gas supplies, and so on. So yeah, so they do the same. They do the same research. They do the same thing.
Yes, of course, because they want to catch the local customers, of course.
Yes.
Otherwise, they wouldn't be there if they don't serve the local needs or the local people.
Right.
Okay, so yeah, another reason is they want to serve the best possible services, because local what they want is
right.
Maybe they're offering petrols, for example, petrol or cafe or mobiles, and so different people will require different things, and so these companies are offering locally needed products and so on. Okay. And also they want to make sure that the presence is there. They catch these customers, and they want to make sure that they don't lose their customers. So there are many different reasons, and one of those things. So where do we get this information? Where do they, where do these people get their information, for making these decisions and, kind of financial decisions? So we said we get these decisions or get from the internal sources and get from the external sources, right? And when they're making decisions, when they're making local decisions, of course, when they need financial decision making, they look at their accountants and they get these informations from internal sources and external sources, as we discussed earlier on. Okay, and they will process and they'll make use of that depending on what the local unit want, what type of decision the local people in the supermarkets, making, or the management, in other words, what they making decisions according to the data they have. Okay. Yes. So they will get different data from, as we said, from internal sources and from external sources. They may get from surveys, they may get from bookkeeping, they may get from other sources, data from different sources. Okay, and then they'll be able to use those sources. Okay.
Yeah.
Right. Also, why do they need when we are looking at assessing the need for financial data, the companies, the organization need to make decisions, and they can use main areas. They need to use this ratios analysis. This is why they need to make decisions. This is why they can use the information according to how much they are making, i.e. profitability ratio. They can use this type of financial data to make sure that they are making profit, they are profitable units. So, and this data or this information they can use using these profitability ratios, i.e. what's the gross profit ratio to sales ratio, for example. How much have they made gross profit according to your sales? How much net profit they've made according to their sales? Yeah, this is the profitability ratio. What type of expenses do they have a profitability ratio? Can they control these expenses compared to sales turnover? Okay, i.e. the expenses ratio. So they can compare from last year to this year and make judgment to control the profitability. Another ratio they can use the liquidity ratio. Liquidity ratio is to what extent the company can meet their current requirements against their debts, for example. Can they meet their needs? Can they meet their suppliers, how much they owe to other suppliers and how much suppliers owe them? And what's their assets and what's their liabilities, you know, how much they are borrowing and how much they should be borrowing and how much can they afford to pay back and so on and so forth. So liquidity, I asked it, what resources do they have to sell, for example, when they find themselves into problems, when they find themselves into debts, you know, can they meet their requirements? Can they meet their current requirements? Can they meet their wages, for example, when they fall due, but they don't have any assets and they can't meet their, you know, working capital requirements and day-to-day running of the business. So we can use the liquidity ratios, okay? And this ratio is a relationship between assets and liabilities. Yeah, okay. Another another thing we make sure that they are using these resources efficiently, so we can get our financial information. We want to make sure that we are using our machinery, we are using our human resources, we are using our buildings, we are using our creditors efficiently, or we are, you know, trying to use less of our creditors, and we make sure we are good in utilizing our debtors resources as much as possible. Yeah, making sure our machinery is best used to get our best returns. And then the last ratio, the last type of areas that we can use our ratios is to look at the financial position of our company. Are we able to meet our requirements according to our capital, according to our ways we're going to get new sources of finances, and you know, do we have enough resources if we want to expand, for example? Do we have enough assets to meet our future requirements and so on, investment purposes, so on. So there we can use these you know, we can use these resources to make decisions. So this is why when we look at 1.2 is assess the need for financial data. We want to make sure that we stay competitive. We want to make sure that we stay ahead of the game. We want to make sure we get the information, right information at the right time, and using the best resources we can. And we want to make sure that we use these financial management, which is the ratio analysis. We want to make sure that we stay competitive all the time and we stay what you call liquid enough to meet our requirements that we need to meet. Because if we can't meet our liquid requirements, if we can't meet our day-to-day requirements, if we can't meet our salaries or bills, then we are having a problem in liquidity. And we must make sure that we don't fall into this trap and we don't borrow too much. You know, we borrow the amount of money that we can afford. Okay. So this is financial management. In other words, we want to stay financially sound. And okay, so that is that making sense? We lost you?
Yes.
Okay,
yes,
okay.
It does.
You're still there. Okay, and the third, when we look at the third assessment criteria is to look at the risks related to financial business decision making. We want to make sure that, you know, when we make decisions, we you know, stay sound And financial management system should be such that it provides our managers, like yourself, financial managers, they make good financial decisions, they make sound decisions, and we should have a management system that is used by management to make decisions, to make sure that it's financially they're making good decisions, financially good control, making sure that the system supports financial managers in making decisions, in financial making decisions, and provides good information so they can keep all the transactions, they can keep all the payments and receivables, making sure that they are in control of all these decision making, making sure that a good financial system provides them with keeping a track of all these liabilities, making sure that the financial system is maintaining income and expenditure statement, and there's a balance between these expenses and incomes, and making sure that the records are up to date, making sure that they are complete and accurate record system, making sure that the minimum mistakes, or minimizing the overall paperwork, making sure that the system is keeps off track of all these liabilities and keep all these assets, making sure that the information we get or information we process is all up to date and accurate. Okay, so there's many reasons, and a feature of a good system is that it should be updated regularly. It has a making less mistake or minimizing the mistakes, making sure that it's up to date, gives you information which you require at the finger of a tip of a finger, for example. Yeah, it's accurate and of course up to date, and gives you accurate system, gives you accurate information so you can process it later. Okay.
Okay.
Yes. Okay. Making sure that you get the information that you need to make quick financial decision making. Okay.
Right.
There are major categories of financial management system. There are 4 types of financial management categories. Number 1 is the cash management, investment management, capital budgeting, and financial planning. So these are the types of categories that we need to look at when we are creating a good financial management system. So the cash management system is cash management means managing cash. For example, your management system should have a good periodic review, a good system that gives you daily records or weekly records, monthly records. So the cash management system is a cash flow system, right? So we should have a good collection of information regarding receipts and payments, for example. Yeah, whatever you receive, whatever you pay, it should give you a good system, good information system. So cash management system is very important because for quick decision making, of course, and making sure that the working capital is all in running nicely and so on. Okay. Investment management, i.e. the investment decisions, i.e. the short-term run or the long run, and the returns available and the alternatives, investments, what type of investments are we going to make in the long run or the short run. So we should have a system of some kind to make sure that we minimize these risks and we maximize our investment income for the business.
Okay.
Yeah. And the third one is the capital budgeting, i.e. this where we're going to invest over a longer term. What is the what's the sort of projects we're going to invest in, what sort of returns they're going to give us, long-term investment, short-term investment, what type of project, what type of payback, the different types of expenditure and the different
right.
Yeah, it's capital budgeting is to do with the evaluating budgeting in long-term, medium-term projects. In other words, are we going to invest in plants and machinery, or projects that are giving us good returns, or projects that are not going to be viable? So this is capital budgeting. Cash budgeting is different, and capital budgeting in investing in capital like buildings and plants and machinery, and investment in the longer run and medium and longer run capital budgets. And there are different decision making, i.e. payback or investment in discounted cash flow projects, or what type of returns are they going to give us, and how much money we need to outlay. So this is to do with capital budgeting. And the fourth one is to forecasting and planning. So the decision making regarding financial forecasting, financial planning for future interest rates, for example, or stock control,
right.
on and financial performance, investment in business, and so on. So these are different trends we need to look at when we are making what you call them, when we are making financial decisions. Okay, so financial decisions based in returns and investment decisions, and capital budgeting and forecasting depends on our data in the past and the forecasting. Okay, and the financial management goals are there to maximize profit and minimize these costs, and maximize maximize your market share. We want to make sure that our value per share, for example, is maximum. We are making sure that our shares, for example, get the maximum return and with a minimum risk. Yeah,
right.
We want to attract our investors to invest in our business, so we want to make sure that our financial decisions are best. Okay, we want to maximize our value to the business. Okay, fine. So people will invest, so the investors can invest in our business. So maybe the banks will lend us money because our financial data is, we have a good portfolio of finances, we have a good portfolio of our investment decision making, and we have a good portfolio of investments and so on. So we have a good strength. We are strong financially. We can utilize our resources to the best. So this is the goal of financial management, is to give you the maximum return with the minimum cost.
Right.
Yeah. So for example, this is very important when you're making decisions. Okay, now to do all these three criterias will get you a pass, will get you get through your a pass criteria. When you come to make sure, when we come to achieve a better grade, you need to go for a merit grade or distinction grade. Then you have to put your own thoughts, put your own views, make your own decision, i.e. you have to assess and you have to evaluate these decisions as to what extent are they strategic decision or
right. Okay.
So you got to decide whether this company is good to invest in, and what's your opinion, what's your input, what's your thoughts about this. Is this company good, or is this company worth not investing in? How would you make these decisions? Yeah, so you need to compare both different companies and make your own judgments. Okay, and this is where your experience and judgment and your assessment comes in.
Right.
Okay, so financial management looks at this type of decision making. So there are different companies. We can look at one or two companies, and you can assess. So for example, here Enron, one company is called Enron, and the other company is called WorldCom, right?
Right.
Scandal. So you can compare these both companies and see how they are decision making in West. So, for example, Enron is saying is a Houston-based commodity, energy, and service corporation, and their shareholders lost $74 billion.
Oh my God.
Yeah. Okay. And you know, because they lost
Yeah.
they lost
They
their
kept debts of the balance sheets. I see it now.
yeah, so they lost their retirement accounts. They and many employees lost their jobs. Now, how did they lose this? Maybe they were doing something wrong. Maybe they're doing something fraudulent. Maybe they were doing something they didn't tell to the shareholders or people. Yeah, maybe they were hiding something or doing something fraudulent. Okay, because they wanted to hide. Yeah.
Yeah.
Okay. And you know, they maybe they kept people in dark. They didn't tell us what they owed, how much they owed. And when they presented this information to people, they made sure that their account looks glossy. They look nicely, because people wanted to look at these accounts, and they were successful company. So the people may have invested a lot of money in them,
Yeah.
but in actual fact, you know, their accounts didn't show the correct
Yeah,
value.
that's exactly the problem we've been discussing earlier, because
Yeah.
the accounts got themselves in a mixed up situation, like when they withdraw raw data that was garbage, and outputted garbage knowledge for the shareholders.
So whatever the accountant gives you, yeah, you rely on this. But
Right.
If he gives you rubbish, then of course you'll get rubbish.
As a result, right.
And then you have to. This is why they are accounts are audited. Somebody else has to look into it, and they'll see from their viewpoint, and independent auditors. They look at these accounts. This is why you have auditors. You have accountants and you have auditors. So this is where, when there is a fraud, then the auditors pick up. Okay. And so this company, Enron, they hide these accounts. They showed their good picture, but in actual fact, they were a bad company, and they lost a lot of money. And somebody's blown a whistle, and they got caught. Okay. And they, the people who were responsible, or the directors, they were put in prisons because they were fraudulent. Okay. And the company's gone bankrupt. So this is one way you can make sure that you look at these accounts and why they, so the information got to be very important, and it's got to be caught earlier on rather than end of the year, or later on when the companies. Similarly, WorldCom scandal. This company is a telecommunication, and it had inflated its account by $11 billion, as much as $11 billion, and they lost a lot of jobs. 30,000 jobs were lost, and they lost $180 billion for investors. So they lost these monies. It wasn't their own people invested in it. Again, these people underlined or underreported their costs. Okay. And they showed that their company was good, and they've inflated their accounts, they inflated their revenues by inflating their accounting entries. So they made deliberate mistakes at the raw data, maybe construed it wrongly, put data into it. Yeah. So that the accountant must have been involved with this fraud as well, and because otherwise they wouldn't have happened. So the information, they lost a lot of money, and they lost a lot of people's money. Penalty, they got penalty, i.e. the sentence to 25 years for fraud and conspiring, for filing wrong data and filing wrong accounts. So therefore, this is, this tells you that the people use wrong information, but the auditors uncovered this fraud. Yeah. So the auditors are people who pick up these problems and pick up these. Okay. So you can see there are other frauds by companies, and this is as financial managers, you need to be able to spot these problems. Okay. Yeah, and you get the information from the accountant, maybe scrutinize and see whether they are telling us the truth or not.
Right.
So financial managers they can compare these accounts. Even accountants, okay, they are giving you the information, but because financial managers, they're going to invest, they're going to look at the performance, they're going to see the company where it's going, they are making a strategic decisions. They are more like a hawk's eye. They can be more like vigilant than the accountants to make sure that the company doesn't create these frauds and so on. So they are much better positioned than the accountants. Okay, in that sense of the word. Yeah, strategically, because if they give you the wrong information, strategic managers probably spot them quickly and get back to the basics.
Right.
Okay, so this is very important. The next thing is we need to look at the term creative accounting. Now this is when these people are using creative accounting in order to inflate these accounts, in order to make wrong judgments, in order to overstate the accounts. This is known as the what you call these creative accounts. They are creating their they're showing their managers, they're showing these companies as to over reporting. Okay, they're trying to show these by using creative accounting to show that the companies are very attractive, they're very successful, they're very profitable, so that they want people to invest in it. Okay, and creative accounting is one way whereby you attract people to to draw attention towards the company, and it's one way to hide a bad company from a good company. It's a way of the creative accounting is one way where you want to show you are good, exceptionally good in your business. You're going to show the best of the picture. You want to give the good impression of yourself. You want to, this is a way of showing that you are boosting your assets and to avoid being taken over. So the creative accounting is a term used, to companies to over-report, for example, and this is what this is what these people have done, to over-report and use the accounting.
Right.
Yeah, so you need to be aware as managers to spot these issues, to spot these things, and there are some regulators who are also there on, like auditors, and they are there to make sure that these are not committed, these crimes are not committed. Okay, and the reasons for over-reporting is you want to conceal long-term changes in profit. You want to make sure that you are creating growth. You want to show the income is good and the profit is very nice, and you want to show that your high expectation and you showing the glossy picture of your company. Okay, so this is and we must avoid this type of over trading. Okay, so as managers, you need to be aware of these things. Okay, not to be falling in trap of creative accounting and making sure that you can spot. So in conclusion, what we've done, the conclusion is the creative accounting should be used to what you call them, to not to mislead users of financial statements, to make sure that you keep an eye on these frauds, and make sure that you look at these as financial managers to make sure that your company is not overvalued. Make sure that you are keeping an eye on them all the time, yeah, as financial managers. There are some references that you can use, and these are your in your Moodle account. You should be able to get those references. In conclusion, what we can say is we think we did a lot of work on looking at how the financial data can be formulated to make decisions. We said we were, the financial information is very important, and we said that financial data should be correct, and to make correct judgments, correct information should be used to make decisions. Financial decisions should be based, and we should try and get the good materials, or the raw data should be good to make good decisions in the future. Okay.
Okay.
Yeah. So in conclusion, I'll say thank you very much for joining, and we've covered 1.1, 2, and 3, and we should be aware of the garbage in and garbage out term. Okay. So it's been a good interactive lesson.
Yes, thank you so much. Thank you very much.
Yes, and we will look forward to joining you tomorrow.
Yes, at the same time. Right.
Okay. Thank you very much. Enjoy the rest of the day.
Thank you. You too. Thank you.
Thank you. Bye-bye.
Bye.